Hi everyone, just wanted to record a little video. I know that many of you guys are completing up chapter 8 and we're entering into both chapters 9 and 10, and you may have noticed that I combined both of those chapters in Connect. It's one of the few times we've done that. So real quickly, the reason why I did that, first of all, chapter 9, we're not going to cover fully all of chapter 9. So you're going to notice in there's really only 3 fairly short topics in chapter 9 that we're going to cover. I think they're all pretty straightforward. Probably the biggest topic in chapter 9 has to do with something called contingent liabilities. And I think if you just watch the videos and read the text, you should be okay on that. Just a few other things about short-term liabilities and things like that. But I think those are pretty straightforward. Just make sure to go through the journal as always and the exercises and make sure to watch the videos. What I did want to talk about, though, is chapter 10. Oh, just by the way, just on chapter 9, too, you're going to see in the book, you're going to see a big discussion on payroll. We're not going to cover payroll at all in this course. I really wish we had the time, but it's just too much. But I do want to talk in this video a little bit about chapter 10 because it is a big chapter. It's oftentimes a confusing chapter for a lot of students. So I wanted to make sure you get off on the right foot on this chapter. So if you bear with me, listen to this video. And it's going to be a little bit long, but I think it should help you. And then, of course, just go through all your normal exercises and things like that you do in the class. So chapter 10 has to do with bonds. And so let me just kind of start out by talking a little bit about what we're discussing here. You may have heard this term bonds before, but what is it exactly that we're covering here? So let me just start with kind of an example, and I think this will maybe help. So let's say you have a company, and let's say that they need to raise a whole ton of money. When I say a lot of money, I'm talking about tens of millions, maybe hundreds of millions of dollars. And, say they want to build a new, corporate headquarters or, launch into a new region or country. It's very expensive. So you think about the options for a company like that. They usually don't have that kind of cash just laying around. So what are the options for them to do so? Well, one of the things they could do, I suppose, is walk into a bank. I mean, like, for instance, if you think about, a big company like, I don't know, just pick a name on, like Microsoft, pretty big company, to come up with, say, $200, $300 million, they could just walk into a bank, say like, Bank of America or Citibank, some big, huge bank, and request a loan. I mean, they could certainly do that. And Bank of America and Citibank would certainly have the money to do that. I mean, they could actually give a $200-300 million loan to Microsoft and probably not even blink about it. But, the problem with that strategy is that it still leaves a lot of risk for that bank. I mean, $200-300 million in any one loan creates a lot of risk for a bank. Now, Microsoft most likely is going to pay that off, but you never know. I mean, as you can see any number of things that can happen with companies nowadays. So, they're taking on a lot of risk if they just, take on one loan for that kind of money. So even though they could do it, it's not likely that they would, in that size. Other options that, Microsoft could do to raise that kind of money is they could sell stock. Now, we haven't gotten into this yet. That's actually the topic of next chapter. But as many of you know, you can sell stock in your company, which is just selling an ownership piece in your company. That would allow, Microsoft to generate that kind of cash, maybe even in a fairly short period of time. But there's some downsides to that. If Microsoft were to sell additional stock, they're giving up additional ownership pieces in the company. And especially if you're a smaller company, this is a really big issue for some companies and owners of those companies. So, you take on stockholders, you got a whole nother, realm of, difficulties that come along with that, like, having to take care of those shareholders, paying out dividends, keeping them happy, and all that stuff that just is part of actually, issuing stock. So that might be an option they might use, but if they decide not to go that route, what other routes do they have? Well, the other thing that they could do to raise that kind of money is they could issue what are called corporate bonds. And really, all this is just going out to potential bondholders, really anybody who wants to invest in the company. And, it's kind of like saying, go out to each one of you and saying, we're going to borrow $1,000 from you, $1,000 from you, $1,000 from you. And so all those potential investors would give, say, $1,000, just as an example, to Microsoft. Now, of course, Microsoft would need a lot of those potential investors to add up to $200-300 million. But assuming they find those, basically it's just saying, well, I've got all these individual lenders that are lending, say, $1,000 to the company. Now, what Microsoft is promising in return in that scenario is they issue a bond to those companies. It's basically just a contract, and that contract says, okay, you're lending me the $1,000, And in return, Microsoft is promising that they will pay a rate of return or an interest rate on that $1,000, much just like a normal loan would be. Okay. Now there are different types of bonds, and you'll read and see the videos on this, but most of the bonds and the bonds that we're going to discuss here in class are what we consider to be term bonds, meaning that they have a specific term that'll be outstanding. Now, typically these might be 3, 5, 10, 15, maybe even 20-year bonds. And basically what the company is promising is that throughout that term, let's say it's a 5-year bond, throughout that 5-year term, the company is going to pay interest to the bondholders, which are the investors, usually semi-annually. Sometimes it can be annually, but usually 2 times a year they'll pay interest to those bondholders. And then at the end of the bond term, say at the end of the 5 years, they'll pay the $1,000 back. So that's one way it can happen. These are what we call term bonds. Now, they can also be secured. We can have secured bonds. Sometimes those bonds will be secured by some form of capital that the company might put up, like a building or a piece of land or something significant. But usually, often, most of the cases, like in the case of Microsoft, which has a long-standing reputation, they'll just issue these bonds unsecured with a promise that they're going to pay these interest rates, and then at the end, they're going to pay the amount off, and that's that. It's a pretty simple process there. So now, what's the process that's involved in issuing these bonds? It's not as easy as I'm making it sound. It's not like they just decide that they're going to issue bonds and then they get up the next morning and boom, raise $200 million. There is an active bond market out there for them to do this, but there is a process involved. Now, in order to understand the accounting for bonds, hear me out here, because you need to understand the process. If you don't understand the process, you'll never understand why we do the crazy things we do when we account for them. So here's basically what happens. The first thing the company, again, we'll use the example of Microsoft, has to do is they have to set their intention. It's just like, okay, we're going to go out and raise this kind of money. And so they notify several agencies. One of the agencies they notify is the Securities and Exchange Commission, the SEC, and any other agencies that might need to know. And the process starts from there. Now, when I say process, what I mean is then at that point, Microsoft would start to put together a set of materials. One of the major materials that they're going to put together is what's called a bond prospectus. A bond prospectus is basically a document. It's like a selling document. It's similar in a way to like an annual report, if you've ever seen an annual report for a company. Very thick document, usually sometimes several hundred pages, with all kinds of data about the company and you know, all this stuff, kind of just selling the company to these potential bondholders with historical data, projected data, things like that. Now, as you might imagine, this bond prospectus takes a little while to put together. On average, it usually takes anywhere from about, I don't know, 2 to 3 months typically. Sometimes it can be a little quicker, but it takes a while to put a prospectus like this together. So once the company decides they want to raise this kind of money, there is a little bit of a lag time between, you know, when they decide they want to raise it and the time they actually go to the market to raise the actual, say, $200 million. Okay, well, that's important because here's what happens. Early on in that prospectus process, the company has to set what's called a stated rate of interest on the bond. Now, that's typically the interest that's prevailing in the marketplace at that moment, okay, at that moment. And they have to set that interest rate, kind of lock it in place. And they're saying, hey, this is the interest rate that we're going to pay on these bonds over that 5-year period, kind of like a fixed rate. That's one way it can be done. Now, here's what happens, though. In that 2 or 3 month period, after that rate's been locked in, that 2 or 3 months goes by, or however long it takes to create that bond prospectus, when the company's finally ready after that 3-month process to go to the marketplace and raise the money, guess what happened to interest rates? They've changed, right? I mean, interest rates move up and down. The company doesn't control that. The market controls that, right? So that interest rate might have gone up or down. And that rate of interest becomes what we call the market or effective rate of interest. So when we deal with bonds and accounting for bonds, we're going to have, in many cases, we're going to have these two kind of countering interest rates that we've got to deal with. And the pricing for how these bonds get priced out and how they account for them is very closely tied to these differences in rates. So anyway, we'll see this. I'll actually walk through an example. I think you'll start to get the idea. But that's kind of what happens and why we do what we do. All right, so let me kind of go through an example or two on this. We'll start with a really easy one. We'll start with a bond that has been issued at par value. So here's what we're going to start with. Let's say you've got a company. We'll keep these numbers like really simple. So let's say you've got a company that says they want to raise, say, $1,000. Now this would never happen, right? A company would never go to the bond market to raise $1,000. But let's say we're gonna just raise $1,000. We'll call that the principal amount of the bond. So I'm going to write this down. I'll show you this in a minute. So we're going to raise $1,000. Principal. So that's what they want to raise. Let's say that the term on this bond, it's going to be a term bond, and the term is going to be, we'll use 5 years as the example. And let's say that when they locked that rate in, when they first started to build the prospectus, let's say that the stated, by the way, they sometimes call the stated rate, they sometimes call this the coupon rate. There's actually some fun history to that. It used to be when you bought bonds that, that as an investor, the company would issue you a coupon book, and then what you'd have to do to go get your interest rate, you have to rip out those coupons, walk into a bank, and the bank would execute the coupon to you. Now it's all electronic, so we don't actually call it that anymore, but sometimes you'll still see it referred to as the coupon rate. So let's say that locked-in rate, right, at the start of the process, let's say that locked-in coupon rate, let's say is 9%, okay? 9%. And let's also say that we've got a semi-annual interest payment. So the company is going to commit to pay out this interest semi-annual. Now, we're going to play with some dates here too, because dates are going to really matter here. So let's just pretend we started this process on, say, October 1st. Okay, October 1st. And so we're going to give ourselves all of October, all of November, and say all of December, say 3 months to get our prospectus done, right? So here's what we've got so far. We've got what? We've got a $1,000 principal, right? We've got a term of 5 years. We've got a stated coupon rate of 9%, and we've got a semi-annual interest payment. Okay, I hope you can see that. Okay, so here's what we've got. So let's flash forward. Let's say we prepare that prospectus, and now let's say that it's January 1st. We'll keep this really easy. It's January 1st. We're now ready to go to the market to raise this $1,000. Okay, we're ready to go. Now, at this moment in time, we're going to look at what interest rates are on January 1st. Now, chances are they're going to be different, right? I mean, most often they're going to move, you know, one way or another. They're going to move up or down. They're going to be different than our locked-in rate. But let's just pretend that everything kind of stayed the same here, and that our effective or market rate of interest, again, two words that mean kind of the same thing here. The effective or market rate of interest here is also 9%. On January 1st. So we'll add that to the criteria. So we got our effective rate is equal to our stated rate. Now, when we have this type of situation, what we say is we're going to say that this bond is going to issue at what we call par value. Par value. Par value. Now, it's kind of a strange name. Basically, here's what really happens in bond pricing. What really happens is that the bond will go through a pricing model. Okay, now we're not going to learn this pricing model, and there's a good reason why. It's just too much for this class. We're just going to go way beyond this. But basically, it uses, I don't know if any of you have any other classes dealt with anything with what we call present value techniques, but present value, future value of cash. It uses a model similar to that. It's not too complicated. It's a two-step model. I actually think it's in the appendix of the book if you're interested, especially those of you that might be finance majors might want to take a look at this. But it's a two-step pricing model, and it basically spits out the price of the bond, but it's really using several factors. It uses the time in the bonds, which in this case would be 5 years. It uses the stated or coupon rate and the market effective rate, puts all this into the model, and then it says, okay, well, what is the price of the bond? Well, here's what I know about this pricing model. Without even running these numbers through it, I know that if my stated rate is equal to my market rate, which is, in this case, it's both 9%, I know that that pricing model is going to spit out a price of par value. Okay, now, so everything with bond pricing, it comes down to basically percentages. So par value in this case would be equal to what we call a price of 100 or 100%. price of 100, okay? That's basically what par value is going to be here. Now, in the next couple examples I go through, we'll talk about some other examples, discounts and premiums, and these are the alternatives. But we're going to just go with this par value. Now, since this bond's issued at a par of 100, or a price of 100, it makes our entries really simple, because what it means is that the company is going to go out to the marketplace, try to raise this $1,000, and because they were able to issue these bonds at par value, the bond price means that they're gonna get the $1,000 into their company. In other words, there's going to be investors out there. They're going to buy these at the full price amount, the full principal amount of $1,000, and the company is going to reap the $1,000. So now again, let's be sure where we're doing these entries from. We're always going to do these entries from the perspective of the company. Okay. So from the company's perspective, are they getting cash? Yeah, they're getting cash. The investors are investing cash. They're giving money to the company, right? So here's what we're going to do. We're going to make the following entry. I'll make this and I'll show it to you here. We're going to start out by debiting cash by $1,000. Just that easy. Now, of course, that's going to be our debit. Every time we have a debit, what do we need? We need a corresponding credit. Well, what does the company now owe? Well, they owe that $1,000 back to the bondholders, right? In addition to interest, which we'll get to in a minute. So the credit side of that $1,000 entry is going to be to bonds payable. So just like that, okay? So this is what we call the entry upon issuance of the bond. That's all this is, the entry upon issuance of the bond. Debit cash 1,000. Credit to bonds payable, which of course is a long-term liability to bonds payable. All right. So let's say that entry happens on January 1st, which was the date that we actually went to issue these bonds, right? January 1st, $1,000 in. All right. So nothing really happens on this bond. Guess what? For another 6 months, because remember, we're going to pay interest semi-annually in this bond. So the next time that anything happens in this bond is going to be what? June 30th here, right? At the end of the first 6 months. So the next thing we just need to do is calculate what interest we're going to pay. Well, all right. Remember, we have our two rates, right? We have our stated rate and we have our effective market rate. We're always going to pay interest at our stated rate. Happens to be the same in this example. But we're always going to pay interest on our stated rate of the bond, which is 9%. Now that's an annual percentage. So we're going to need to put that into terms of just 6 months. So let's go ahead and do that formula. If you remember, our formula is always going to be what? Interest times principal times time. I'm sorry, principal times rate times time. I said that wrong. So principal times rate times time. So what's our principal here? Well, our principal is $1,000, right? And our rate is what? 9%. That's an annual rate. And we're looking for just 6 months, right? So we're looking at taking this 6 over 12, or basically halving it. So there's our formula right there, right? 1,000, there's our principal amount, times our annual rate of 9% times 6 over 12, or halving it. So when we do this calculation, what do we end up with? Well, we end up with $45 as the amount of interest that we're going to need to pay out these bondholders at the end of the 6 months, right? Okay, so what's the actual entry? Pretty simple. We're just going to, from the company's standpoint, we're going to credit cash and we're going to debit interest expense. That's all it is. We're going to debit cash, credit interest expense. We do that on 6/30. And then we're going to do that same entry again 6 months from now and 6 months from there. How many total interest payments are we going to have on this bond? Well, think about it. You've got 5 years as the term, right? You're paying out twice a year. So you're going to have 10 total interest payments. So I won't write all those out, but it'd be the same. It's $45 every 6 months. At the end of that 5 years period, what happens? Well, you pay your last interest payment, right? And then at the end, you're just going to pay off this $1,000. Credit cash, debit bonds payable, and you're done with the bond. A bond issuance of par is pretty straightforward. You can see nothing difficult there, all right? Let's take this same scenario, though. Let's take this same scenario and let's change it a bit, all right? Let's just change it just a little bit. All right, we'll keep some of the things the same, right? We'll keep some of the things the same. For instance, we're still going to keep the principal at $1,000, okay? So that's going to be the same. We're going to keep the same term at 5 years. We're going to keep the stated rate, the stated or coupon rate. We'll keep that at 9%. And we'll say that, once again, is semi-annual. The only thing we're going to vary here is the effective or market rate. Okay, so and again, just to recap here, why would this vary? Well, think about it, all right? If, let's say we again start this process in October 1st, we give ourselves 3 months. But at the start of the process back in October, we set that stated rate. It was 9%. We go through the 3 months now. All right, now listen carefully. It's January 1st now. We're ready to go to market. Well, now we're going to look at these market rates again, right? Chances are they've moved, right? Chances are they've moved. They've changed up and down. Remember, the company doesn't control this. The market controls this, right? So let's say the market rate now is, let's say it's 10%. It's 10%. Rates have increased on us. They increased on us. Okay, so here's what's going to happen. We're going to take all this information here, right? Here's our new information, right? Same as old with one exception, right? We're going to take all this information. We're going to run it back through the pricing model. Now, again, don't try to calculate this on your own. I mean, for us to calculate this price without using the pricing model, it won't work. There's no physical way to do this without running it through the actual pricing model. We're not covering that here. What's going to happen in the problems that you guys are going to do in this chapter is they will give you a price. But here's what I know about this price. Just like I knew if the stated rate and the effective rate were equal, that was going to be par, meaning the price was going to come out equal to 100. Here's what I know. I know if the market or effective rate is higher than the stated or coupon rate, guess what? This bond's going to issue at what we call a discount. A discount. Or in other words, something less than 100. All right? So the way we actually look at, I'll just kind of boil this down. I mean, the way we look at bond pricing and the pricing model is we have par, and par is equal to 100. I'll show you this in a second. Any price below par is issued at what we call a discount, and anything above par is issued at what we call a premium. Makes sense, right? So you can kind of visually look at it this way. So you have par equal to 100, and if you have a bond price below 100, it's going to be issued at a discount, and if you have a bond price above 100, it's going to be considered what we call a premium price, okay? So this particular case, I know that just the relationship and how the bond model works is that the bond's going to issue at a discount. Now, okay, so let's think this through. Basically, here's what we're saying, okay? We're saying that the company up front back in October had to commit to a stated rate of interest. In this case, in this example, it was 9%, right? It was 9%. That was what they committed to. Basically, what they're saying is over that 5-year period, that's what they're going to pay. Now, 3 months have gone by, right? 3 months have gone by. It's now January 1st. It's January 1st. And so that bond interest rates changed, right? I mean, market rates have gone up. So here's what's happening. The company is now going to potential investors. And just think of it this way. You know, you're a potential investor. Let's say you've got $1,000 in your pocket, right? And you're trying to figure out where best to invest your money. So you got a company like us coming along and saying, hey, we're willing to give you 9% annually on the money that you're going to invest. 9%. That's what we're willing to pay you. Now, you got that money in your pocket and you're looking around and you've got similar investments with similar risk, but you can earn 10%. Why would you buy our bonds? You're not going to, right? I mean, there's no way you're going to do that. Why earn 9% from us when you can go earn 10% with similar investment with similar risk? So here's what we have to do from a company standpoint. We have to discount those bonds. We have to discount those bonds. That's why I know that if the effective market rate's greater than the stated rate, we're going to end up with a discount price. So that's really kind of in a nutshell, kind of the way the bond pricing model works. This is kind of a simplistic way of kind of viewing the way the bond pricing model works. But it really is. It's kind of like a supply and demand type deal, and it takes in that present value, future value type relationship and the time and all that. So that's how it works. Now, again, the price, in your guys' problems, you're going to just be given this price. So you don't have to worry about this too much, right? You're going to be given the price. But it's helpful to understand that if you have that relationship, if the market effective rate's greater than the stated rate, you're going to have a discount amount, right? You're going to see problems like that, and they're going to want to know that you understand that. So the actual price is going to be given to you. So like in this case, let's say we run these numbers through the bond pricing model, and it spits out a bond price of, say, 98. Okay, so let's say it prices this bond at 98. Again, don't try to calculate this. You're not going to be able to do it unless you understand the bond price amount. So don't worry about it. Just accept the price that they give you in the problem. In fact, I know this is not accurate, but I'm just going to use it for example purposes, all right? Because it'll get us where we need to go in terms of our entries, all right? So let's say it spits out 98. All right, so here's what we're going to do. We need to do, where it's January 1st, remember. So we need to do the entry upon issuance of this bond, okay, on January 1st. From the company's standpoint. So how much money is the company going to get? Well, think about it. Remember, they were out there trying to get $1,000. That's what they originally wanted to raise, right? $1,000. But because the company had to discount this bond issuance, they're not going to raise $1,000. In this case, they're going to raise something less. Well, how much less? Based on the bond price. So here's all we have to do. All we have to do is take that $1,000 principal that we had, and we're going to multiply it by that percentage. 98 would be 98%, or 0.98, right? 0.98. So we're going to multiply that $1,000 by 0.98, and of course, what do we end up with? $980, right? So there's your key calculation, because that's how much cash the company's actually going to get out of this bond upon issuance, okay? $980. That's how much they're going to get. So you're always going to start, when you're doing a bond problem, you're going to look at the price of the bond, you're going to multiply that price by the principal, and then your first entry is going to be a debit to cash for whatever that result is. So we're going to debit cash $980, all right? That's going to be our first entry. Okay, now we got to finish this out, right? So here's the next question. Remember, the term of this bond was 5 years, right? So what do we credit bonds payable for? We certainly have a liability here, right? But in 5 years, how much does the company have to actually pay back? Well, here's the trick. The company doesn't have to pay back $980. They actually have to pay back a little bit more at the end of 5 years. Guess what? They've got to pay back the full principal amount of $1,000. So we're going to credit $1,000 to bonds payable. That's going to be the second piece of this entry. So we had a debit to cash of $980, a credit to bonds payable of $1,000. Okay? All right. Well, you can see here, I got a problem, right? My debits don't equal my credits. That has to happen. What do I need to balance this out? Well, look at it. I need another debit, don't I? Equal to $20, which is the amount of the bond discount, isn't it? Well, lo and behold, look what I have. I have a discount on bonds payable account. Perfect. So what I'm going to do here is I'm going to debit $20 to that discount on bonds payable account. And that's going to complete out my entry upon issuance. Debit cash $980, credit bonds payable $1,000, debit discount on bonds payable $20. Now, if you're wondering what kind of account this is, it's a great question. If bonds payable is a liability, guess what this is? This is a contra liability. Remember, contra meaning what? Opposite, right? So this is opposite of a liability. These accounts, think of these two accounts as kind of going together. In fact, we have a very important concept when we're talking about bonds called the bond carrying amount, or what is the carry or carrying amount of the bond? Well, in this case, the carrying amount of the bond would be the bonds payable of $1,000 minus the debit here of $20, which is the amount of our discount, right? So the carrying amount of this bond at this moment in time would be what? $980, which happens to be equal to the cash value here, right? So at the entry upon issuance, your carrying amount is always going to be equal to the amount of cash that you put as a debit here. But really, the true calculation of carrying amount is the amount that's in your bonds payable, and in this case, less your discount. That would be your bond carrying amount. All right? Great. All bond problems are going to start with this, the entry upon issuance of the bond. Need to know how to do this, need to know how to calculate it, all right? Then the bond problem is going to progress. Now, again, remember, we're paying interest out semi-annually. So just like before, nothing's going to happen on this bond for another, what, 6 months. But let's flash forward to that 6 months. In 6 months, right at the end of June here, we're going to need to do two things, okay? The first thing we're going to need to do is we're going to need to pay interest on this bond. Just like before, right? Now, here's the question. I got two different rates here, though, don't I? Which rate do I need to pay at? Well, if you recall, I said before, the company's always going to pay on the stated coupon rate. Really important to remember that. It's a great place to mess up. But we're always going to pay on the stated coupon rate, which in this case is 9%, right? So guess what? This calculation is going to be exactly as the one before, right? We did this already. We said, well, if we have our principal amount of $1,000, right? We're paying at 0.09, right? And we're going to multiply that which was $90. We're going to multiply that by 6 over 12, or half it, right, which is $45. So that calculation didn't really change. It just did a slightly different way there. But you can see here, that calculation is exactly the same. Principal times the annual rate times time, right, $45. So I'm going to start out by paying that interest. So how's that going to work? Just like before, we're going to have a credit to cash of $45, and we're going to debit to interest expense $45. Just like before, no difference, okay? But I said that was only one of two things we've got to do. We've also got to do something else here, all right? So now pay attention to this, because this is where it gets a little bit in the weeds with bonds, but just follow me here. The next thing that we're going to have to do is we're going to do something called amortizing the discount. Now, you may remember this term. We actually discussed amortizing. I think it was in the last chapter. We talked about intangible assets and amortizing those assets. So amortizing is basically just like drawing down the balance, isn't it? That's really what amortizing is. So what balance do I have in my discount account? Well, I have $20, right? $20 in my discount account. I need to amortize that. I need to draw it down. So let me walk you through the mechanics of this, and we'll talk a little bit about the why we do it, okay? But let's walk through the mechanics first. A couple of different ways I can do this. One of the easiest ways, and the way they're going to start out with you in the problems, is going to have you do what's called a straight line amortization. Remember that term, straight line? Really easy, straight line amortization. Here's how we're going to do it. We're going to take this $20 of amortization, or $20 of discount, and we're going to amortize it over the number of interest periods in the bond term. Well, let's think about that again. What's my bond term in this case? 5 years, right? How many total interest payments am I going to have? In other words, how many times am I going to make this $45 entry? Well, a total of 10 times, right? 5 times 2 times a year. So what I'm going to do is just take this $20, and take this $20 of discount. I'm going to divide it by 10 interest periods. 10 interest periods. So, of course, what does that leave me with? $2 of amortization, right? So I'm going to take the 20, I'm going to divide it by 10 periods, 10 interest periods. I'm going to have $2 of amortization. Okay, so remember, again, think about what amortization means. It means just drawing the balance down, right? So again, I've got what? In my discount account, I got $20. I need to draw that balance down. So let's think of the entry we're going to make. Now, again, this is going to happen at the same time, by the way, as my interest payment, the $45. So these entries happen kind of simultaneously, and this would happen at the end of June, right, after the first 6 months. So the first thing that I'm going to do is draw down my discount. Well, think about that. How am I going to do that? Well, if I've got a debit balance already in here, $20, how would I draw it down? Well, I would need to credit it, right? I would need to credit that balance. That's going to draw the balance down, isn't it? Okay, now what do we know? We know that every time we have a credit, what do we need? We need a corresponding debit, don't we? All right, here's where the debit's going to go. The debit's going to go to interest expense. Okay, let's put it there, and then we'll talk a little bit about why. Okay, we're going to add that $2 to interest expense. So your amortization entry here is a credit to discount, drawing it down, and then a debit to interest expense, effectively increasing your interest expense. All right, so let's think about why this happened the way it happened, right? Now, before I talk about that, though, again, just mechanically, remember, these two entries, the $45 and the $2, that's going to happen every 6 months now for what, 9 more periods, right? 9 more periods. At the end of the 9 periods, what's going to happen? Well, all my discount will be amortized right down to 0, and all of that discount will effectively end up in interest expense just spread out over the 5-year period. And that's basically what's happening here, right? And it's just going to be spread out. So that's how we amortize it. We just amortize it slowly over time. Now, okay, well, why does this work the way it worked? Well, why do we especially debit interest expense here when we're amortizing a discount? Well, in order to understand this, you really have to go back to kind of when this bond started. Remember, going back to January 1st, the company wanted to originally raise how much? $1,000, right? But because interest rates didn't move in their favor, right, they went up, they were only able to raise, what, $980. Remember, we had to discount it, right? So the investors only gave the company $980 when they originally wanted $1,000. But if you recall, when we made that entry upon issuance, listen carefully now, when we made it, we originally put $1,000 of bonds payable, even though we collected $980 in cash. And we said, well, so $980 came into the company, but at the end of 5 years, we still got to pay $1,000 back. Now, think about that. If somebody gives you $980, but still tells you, hey, you got to pay $1,000 back 5 years from now, that extra $20 that you paid, what is that to you? It's interest. It's interest, right? I mean, it's just basically they're lending you money, you're paying more back at the end. That's interest. That difference is interest. So this discount, this $20, that difference between the $980 and $1,000, it's effectively really just additional interest that the company is going to pay over time, isn't it? So that's why we're going to take this discount and amortize it to interest expense. We're just going to spread it out over time. If you're wondering what principle is at work here, guess what? It's the matching principle, right? We're matching expenses and revenues in the same accounting period. We're spreading this interest over that 5-year period, okay? Another way to kind of like maybe help you understand this concept is kind of think of it at the end. And if I were to continue this problem, let's say I were to flash forward another 6 months, right? And I were to say, okay, you know, what interest would we make? Well, we would make another $45 too, $45 too. We would make that one 9 more times. At the end of the 5-year period, right? When the whole 5 years is said and done, what interest rate did the company really pay at? Think about it. Remember, we were only paying at the stated rate, which was the 9%. That's how we calculated the $45, right? But what amount did we really pay? Now remember, we had to pay that extra 20 bucks essentially at the end, right? Because we had to pay the $1,000, not that $980 back. So the extra $20 basically made up for the difference between this 9 and 10%, didn't it? So the reason why we call this the effective rate of interest is because if you actually look back over time, you say, well, how much did the company really pay out? They're really paying out at 10%. Which is the effective or market rate of interest, okay? So this, you know, the fact that the interest rates moved, you know, not in our favor, ended effectively just saying, well, we had to pay more interest, right? We effectively, the company, to, you know, borrow this money, they effectively really had to pay 10%, not 9%. So it's kind of a quirky thing we do with bonds. It's been like this for a long time. It's kind of a lot of mechanics that are kind of quirky from an accounting standpoint, as you can see that. But once you kind of get it down, it all works exactly the same way, all right? Okay, hope you follow that. Let's do another example. Let's do one more, but I want to show you how this works with a premium. It works basically the same way, but a premium is just the opposite of a discount. So here's what we'll do. We'll take the same example once again. I'll write it out. So once again, let's say we have a principal of $1,000. And let's say we have a term, once again, of 5 years. Let's say, once again, let's say it's October 1st. And we go and we look at the market and we say, well, the stated coupon rate, we lock this in. Once again, we'll lock it in at, say, 9%. We're going to pay semi-annual. All right. But this time, the 3 months goes by. Remember, we're putting that prospectus document together, right? And we say that the effective or market rate of interest this time is moved once again, right? More likely that it will move some way, somehow. But this time, let's say the market or effective rate moved down. Let's say it moved down to 8% from 9%. Okay, so here's what we're going to do. So here's our new set of examples, right? Everything's pretty much the same, except we're going to change that effective rate now to be below the stated rate. So here's what we're going to do. We're going to run this through the pricing model once again, okay? Don't try to calculate this. You got to be able to do it through the pricing model, and it's going to spit out a price. Now, here's what I do know. I know that